Good morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
Welcome to T-Hub Capital's The Investors Lounge weekly podcast. Today's date is the 15th of December. Let's dive into the week's top market news. European markets diverge as ECB signals hawkish turn amid UK economic contraction. European equity markets closed last Friday with mixed results on the day, leading the Pan-European Stocks Europe 600 index to finish marginally lower in local currency terms. While Germany's DAX and Italy's FTSE MIB managed to secure gains of 0.66% and 0.19% respectively, other major indices faced headwinds. France's CAC 40 retreated by 0.57%, and the UK's FTSE 100 slipped by 0.19%, reflecting a lack of uniform direction across the continent's major exchanges. The narrative surrounding the European Central Bank, ECB, is shifting markedly toward a more hawkish stance, contrasting with previous market assumptions. Executive Board member Isabel Schnabel signaled comfort with market expectations favoring a rate increase over a decrease, citing upside risks to both growth and inflation. This sentiment was bolstered by ECB President Christine Lagarde, who highlighted the Eurozone economy's resilience against trade tensions and hinted at upgraded growth projections for the upcoming December meeting. Other officials, including Gediminas Simkus and François Villeroy de Galhau, reinforced the view that further rate reductions are unnecessary, advocating for maintaining the current 2.0% borrowing cost. This outlook aligns with a recent Reuters poll, which indicates that the ECB is poised to keep rates steady next week, with a vast majority of economists expecting no changes through late 2026. In stark contrast to the Eurozone's potential resilience, the United Kingdom's economy is showing signs of strain, weighed down by budget uncertainty and rising tax burdens. GDP unexpectedly contracted by 0.1% in October, marking a second consecutive month of decline and missing economist expectations for growth. While production saw a rebound following the restart of Jaguar Land Rover operations, the broader economy was dragged down by weaknesses in the critical services sector and a sharp fall in construction output. This economic fatigue has extended to the property market, where the Royal Institution of Chartered Surveyors reported a notable cooling in November, with housing demand dropping to a two-year low. Meanwhile, the Swiss National Bank adhered to expectations by keeping its policy rate unchanged at 0.0%, citing soft inflation figures and sluggish economic activity. Now our insight into alternative markets. Strategic liquidity. How the secondary market is engineering the future of space investing. In the rapidly expanding universe of private capital, few sectors have demanded a financial evolution as urgently as the space economy. Historically, space investments were viewed as moonshots, illiquid capital locked away for decades in government contracts or research-heavy startups. However, as we move through late 2025, the narrative has shifted fundamentally. The secondary market has transformed from a distressed exit ramp into a sophisticated propulsion system for active portfolio management within the space sector. In an environment defined by high interest rates and a blocked IPO market for deep tech firms, secondaries have become the critical strategic lever for both limited partners, LPs, and general partners, GPS, looking to capitalize on the global space industry, which now exceeds $600 billion in value. To truly understand the strategic value of this market, one must distinguish how specific transaction types apply to the unique timeline of space ventures, starting with the liquidity paradox found in deep tech. In the traditional scenario known as LP-led secondaries, a limited partner, such as a pension fund or family office, sells their stake in an existing deep tech or aerospace fund to a secondary buyer. This dynamic is particularly relevant today because many early investors in new space funds from the 2015 to 2020 vintage are sitting on massive unrealized gains from industry titans, yet they lack actual cash distributions. By acquiring these stakes, secondary buyers can effectively bypass the risky 5-year R&D valley of death. They enter the investment curve when the underlying portfolio companies, such as satellite constellations or orbital logistics firms, are already operational and generating revenue. This allows the buyer to mitigate the notorious J-curve of space investing, stepping in exactly when the asset is poised for growth. While LP-led deals provide a rebalance, the area of greatest innovation is undoubtedly found in manager-led transactions, or GP-led secondaries. Here, a fund manager orchestrates the movement of trophy assets, such as a stake in a major launch provider or a private space station developer, into a continuation fund. This mechanism addresses a critical mismatch in the sector. Space companies often require 10 to 15 years to mature, significantly outlasting the standard 10-year private equity fund lifecycle. Instead of forcing a premature sale of a future unicorn to meet a deadline, the GP creates a new vehicle to hold the asset. This results in a dual benefit where existing LPs get a chance to cash out, while the GP and new investors double down on a proven winner that is perhaps only a few years away from a massive exit or IPO. Looking at the data for late 2024 and 2025, the secondary market in space is thriving precisely because of current macroeconomic friction. While the IPO window remains narrow for all but the largest players, secondary volumes are breaking records, anchored by the SpaceX effect. The market has been reshaped by massive tender offers from sector leaders, most notably SpaceX, whose recurring secondary rounds have normalized the idea that going public is no longer the only way to reward employees and early investors. With valuations nearing $800 billion, these massive liquidity events have created a ripple effect, encouraging secondary trading in other late-stage players like Axiom Space and Sierra Space. This activity is further fueled by the denominator effect, where many institutional investors found themselves overexposed to private asset classes and were forced to sell high-quality space portfolios to rebalance. This has created a buyer's market, where firms can access top-tier aerospace assets at attractive valuations, often trading at par or with single-digit discounts to net asset value, NAV, signaling immense confidence in the sector's long-term trajectory. For forward-thinking investment firms, active engagement in the space-focused secondary market is no longer optional. It is a competitive necessity. In a landscape where traditional exits are increasingly complex and rare, the ability to leverage secondaries to generate early liquidity or access pre-IPO giants has become a defining superpower. We are witnessing the maturity of the asset class, where the secondary market has evolved beyond simple buying and selling into a form of sophisticated financial engineering. It is this strategic depth that ensures the capital fueling our expansion into the cosmos is as resilient as the technology itself.
Thank you for listening to this episode of T-Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode, and share it with your friends and colleagues who might be interested. To learn more about T-Hub Capital and our activities, visit our website, thubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T-Hub Capital team.